Ever wondered why U.S. inflation didn't completely skyrocket, even when the Fed jacked interest rates to the moon and workers kept demanding higher pay? Most people think it's just the Fed playing 4D chess. But the dirty secret is, someone else silently took the hit for the American economy, and that someone is sitting over 6,000 miles away in Tokyo. It all started with a massive interest rate gap. The Fed raised rates sky high, while the Bank of Japan kept theirs practically at zero. Result? The Japanese yen crashed by 30%. Under normal circumstances, America would be trapped in a deadly economic loop.
Hey, boss. Burgers are $10 now. I can't live like this. I need a raise.
Fine, here's your raise. But now I gotta sell burgers for $12 to pay you?
Wait, what? Burgers are $12 now? I need another raise.
That's the classic wage price death spiral, basically trying to fly by pulling your own hair. It never stops. But then, Tokyo stepped in. Japanese machinery, parts, and materials suddenly got ridiculously cheap in dollar terms. Cheap Japanese imports acted as a massive relief valve. By slashing input costs for U.S. manufacturers, it gave American bosses zero reason to raise burger prices. Japanese workers absorbed the import inflation at home. But the financial game, that's where things get truly wild. If the industrial route is a discount, the financial route is pure, unadulterated free money hack. Since borrowing yen cost basically zero interest, Wall Street traders executed a classic carry trade. Borrow dirt-cheap yen, convert them into U.S. dollars, and dump them straight into U.S. equities and treasuries. That massive wave of yen-funded capital became one of the structural pillars keeping Wall Street booming. And it didn't stop at stocks. Japanese institutions, desperate for yield, flooded the market buying U.S. treasuries. High demand pushed treasury yields down. And when yields drop, borrowing costs fall across the entire American economy. Lower mortgage rates, lower auto loans, and cheaper business credit. On paper, the Fed tamed inflation. But under the hood, Japan was footing the bill with cheap goods and ultra-cheap capital. None of this is a conspiracy, just what happens when two massive economies diverge on interest rates while staying financially glued together. But here's the real question. How did Warren Buffett use this exact glitch to pull off a multi-billion-dollar, nearly risk-free trade? I've broken down the exact trade mechanics, balance sheets, and numbers in my full Substack article. The link is pinned in the comments below. Subscribe to catch the next breakdown, and I'll see you next time.